Hi there everyone, morning and welcome to the market right here on ET Now. I'm Avan Dabash, with me Nikunj Dalmia as well as Anisha Jain. It's going to be critical in terms of the Fed meeting this week, but if we're summing up the week gone by, well, you did have the equity markets which did manage to end at a record close. But that aside, it's also the spotlight on the world of sport, because for a record 8th time, Team India is actually at the Champions of Asia. The men in blue went on to defeat the hosts and defend the champion Sri Lanka in the final of the Asia Cup 2023. And how at that? Despite losing the toss and having to bowl first, the Indian Pacers put on a show which would have made the greats of the past exceedingly proud. The fast bowlers took on all the wickets as they ripped into the Lankan batting unit and bowled them out for 50. Mohammad Siraj was the chief protagonist, claiming 6 scalps. Hardik Pandya took 3 wickets, while Jasprit Bumrah claimed a solitary wicket. The men in blue chased down the party total in no time, with Shubman Gill and Ishan Kishan getting off the blocks and winning the game just in 6.1 overs. So memorable it was in the world of sport, and ditto when it comes to the equity markets. Yes, we did manage to close at a record high. 11 straight sessions for the Sensex in particular is what they've gained, and it's been the longest gaining streak since the year 2007. So yes, for the week gone by, we have managed to gain close to 2% for the frontline indices, and this time around it's been the broader markets that have taken a bit of a backseat. So Nikunj, we've been talking about the lay of the land, and for now, we're holding out quite comfortably.
The trend is intact, and even though you can say that there are not too many good things which have happened in last couple of days, but the bulls in a sense have really muscled it up. On expected lines, frankly, if you ask me, Nifty and benchmark indices are doing much better than what the broader market is doing. So there is a bout of short covering, fresh commitment has come into the banking stocks, and the flows, which in a sense were slightly patchy, they've got cemented further. So the inertia in the market may have moved from mid and small cap stocks to large cap stocks in terms of outperformance. I think that is real, that is here to stay. For the sake of turning bearish, you should not be bearish. The best strategy in this market is that you want to stay with the trend and perhaps avoid making some costly mistakes. What are the costly mistakes? The costly mistakes are that if you chase some of the overbought names in the small and the mid cap space, when they will reverse, it will hurt you like it did on Tuesday. But by and large, I think the trend is intact. The mood is solid. You want to stay with the market and avoid costly mistakes.
Avoid costly mistakes, stay with the momentum, and right now the momentum seems to have shifted towards the large cap banks, large cap names rather, and it's the banking space that was rallying last week. It was the PSU banking index which was up a solid 7% in the week gone by, the best performing sector by a huge margin. In fact, for the last many weeks, months, and in fact year to date as well, we have seen it has been the massive outperformance coming in from the PSU banking space, of course on account of stronger recoveries that are expected and the fact that the asset quality has turned a lot healthy. But I also wanted to bring on board the valuation picture now, because that will tell you that the valuation, Nikunj, of all the public sector entities are now higher than the 5-year average, while if you look at the private banks, they're still cheaper than the 5-year averages that we have seen in terms of valuation. Tells you, if at all, if there is a room for private banks either to catch up, or do you think this rally in PSU banks will continue?
No, I think the rally in PSU banks will continue. I'll tell you why. What markets are not realizing is that you cannot compare last 5 years. Why? Because the historical number for PSU banks were very different than what the future reality would be. Banking is not like FMCG that it's a trend which you follow. PSU banks have gone through a lot of churn because of the cycle and because of the NPA issues which had hit them. So last 5 years, you can look in isolation and talk about, okay, last 5 years, valuations were X, now valuations are Y. I think the reason why PSU banks are outperforming is because they are cheap. B, they have a huge liability advantage. C, in terms of the way some of the large PSU banks, I'm referring to large PSU banks, SBI, BOB, the way they've also built up their technology platform and the retail franchise, I guess in the near term, you may say that the real outperformance in PSUs is here. So asset quality is healthy, valuations are strong, and even the recoveries have been very decent. You throw it up with the technical angle, and if you look at the technical aspect here, which is what the PSU banking index did last week, I guess technically it was again a very important week. So if you put everything together, the technical momentum, valuations, and the near-term tailwind for the sector per se, I think the outperformance is here. The outperformance is real. That's the sense I got from Mr. Khara also. That looks State Bank of India will grow. He's talking about a 3 to 5 year cycle. So I'm not saying that you get carried away, but you want to be with banks. Just because PSU banks have gone up, that does not make private banks look good. And just because PSU banks have not made money in the past does not mean they will not make money in the future. What do you want to avoid here? A small PSU banks. They don't have scale, they don't have reach, and they don't have a strong liability franchise. So what do you want to do? You want to be with large 3-4 PSU banks, and this trend in the near term and in the medium term, I think is real.
Okay, that's the cue coming in when it comes to PSUs. Nikunj, you didn't even wait a breath when Anisha asked you the question, so it seems that you're pretty confident about this rally continuing. But let's also talk about the global setup, and you had the US markets which wrapped up in the red on Friday's trading day, but what investors are closely watching out for, that's going to be what the Fed is going to do, perhaps hold interest rates steady, also getting a sense on the inflation trajectory here on. But that's the map out of the global indices last week. It was clearly the European markets, the FTSE, that managed to outperform. You also had our own markets, which were right up there. The Dow Jones pretty quiet, and the Nasdaq wrapped up the week lower by about 0.33%. It is going to be critical to map out all of that data. But Nikunj, just as we're watching what happened last week in terms of the overall FII sell number for our own markets, the sell figure, we have managed to be at par with the outperforming countries.
So Avan, look, India is like the rising star, not the rising star, but the established star. Rising star we were a couple of years ago, now we're the established star. Within that, if you look at the flows which Indian markets have attracted, they're not at par with what you would have said is very, very one-sided. Indian markets have benefited and other emerging markets have also benefited. 2022 was a year when flows were not great. 2023, the flows have come back. And in the month of September and late August, the flows actually have turned volatile. So I don't think from a market standpoint you could say that FIs are just buying everything and anything. Yes, there are a lot of block deals. Yes, there are multiple things which are happening in the IPO market. But in terms of a real precipitous flow, I think it's not there. It's very measured. So the appetite to buy into Indian stocks at any price, at any level, I think it is not insatiable. With this kind of positioning, the flows should have been insatiable. The point I'm trying to say is that I think the good news for us is that we are moving in line with global markets. The flows at best, you would say they are mixed. And it is not that because of flows, any kind of a bubble, any kind of an euphoria has happened, which is what we let's say saw in 2008 and even in 2014-15.
Okay, so it's staggered flows that we have been getting into India, but at least it's consistent. At least that's what we are witnessing in the last few weeks. Just wanted to spend a minute on the FOMC rate decision as well, which is of course the biggest event of the week, wherein over 99% of the participants are expecting a hold to come by. The bigger decision will of course be on dot plot if there is any change with respect to their estimates of inflation as well as GDP for the rest of the year and for next year as well, because now the biggest thing that the market is watching out for is when does the rate cut cycle begin. For now, large part of street is expecting it to happen at the end of next year. The other big question is what happens in November. 30% of the participants believe there's going to be a hike in November, so we'll watch out for those details as well. But that's of course the big global event wherein we'll get the decision on Wednesday night. But what about today and how you should position yourself ahead of that big event which is lined up? We have our technical experts as always with us, Nooresh as well as Kunal Bothra. Nooresh, let's begin with you. Last week was a pretty decent one. We managed to hit a record high level led by those PSU banking names. What do you think is in store for us this week?
So the trend remains positive. Overall, a little bit of a pause could be okay for a day or two, given that we have a curtailed weekend this week out here. But the trend is 19,800 now becomes a base and 20,500 becomes an upside on the Nifty. On the Bank Nifty, we are setting up for a move towards 47,000 and crossing 46,300. 45,700, 45,800 should now become a base. So overall, a slow and steady uptrend should continue along the major indices. The broader markets have made a feeble recovery relatively, but the the trend is still positive over there, but it would get more selective on the broader markets. We would not see say a rally which has been all across or very secular. So we could get more selective on the broader markets, but the large caps look interesting.
All right, let's connect with Kunal Bothra as well, who's joining us in our studios. And Kunal, it was pretty much a stellar week for the equity markets. PSUs as well proved their might. Do you believe that the resilience is here to stay?
Well, the resilience is here to stay and sustain, and I think the index to watch out for it would be Bank Nifty, because we flagged off the data on previous week that there's been a massive short covering for the Bank Nifty, something which we've not seen at least over the last 3-4 months. And given the tonality of the banking stocks, the private sector banks making a comeback, PSU stocks on the banking side making a very strong comeback from their 2022 highs, many of them showing returns of more than 30-40% so far this in the last couple of months, indicates that this momentum is here to stay, sustain, as well as grow strong for the banking index. And I think with more short covering, which could be in due for the banking stocks, we could probably be getting into a very strong range of outperformance for the Bank Nifty. So I think the Nifty is a bit subdued when you look at it in terms of the price comparison with respect to the Bank Nifty. I think that's where one should be focusing on, specifically if you're an index trader.
Okay, focus on Bank Nifty, especially if you're an index trader. But if you want to dabble into stocks, Kunal, which are the stocks you would recommend?
Well, I'll suggest a couple of stocks in terms of the way the charts are positioned for these names individually. So the first one which I am suggesting is actually a buy on one of the stocks which we discussed last time around. That's a buy on TVS Motors. I think that's a start. That's a chart which is actually looking very attractive. We've discussed that how many of these auto stocks are making a comeback. TVS Motors managed to break past about the 1500 levels on Friday, so would suggest a buy with 1575 as a target and stop loss at 1460. Bandhan Bank is the other stock which also looks attractive, especially in terms of a head and shoulder breakout, inverted head and shoulder breakout. 260 as a target, stop loss at 240.
All right, there you have it. It's TVS Motor as well as a Bandhan Bank that Kunal is flagging off. What's on Nooresh's radar this Monday morning? And Nooresh, run us through your large cap bets.
So two large caps here again. So first is a buy on UPL. The stock has seen a recent enough correction over the last couple of years, and now the stock has started making clear signs of bottoming out. Good price action over the last 3 sessions, relative strength as well. So a buy on dips and at current levels, stop loss at 620, target price of 680 plus. Second is a buy on Mahindra and Mahindra, which continues to be the leader in the auto pack. Made a new 52-week high and an all-time high last week. Short-term range breakout here above 1600, 1610. A target price of 1700, stop loss at 1570.
Okay, so those are the top recommendations coming in from our chartists, autos and banks. These are the 2 spots that they have chosen and the stocks within that. But the other stocks which will be in focus on account of fundamental news flow, Somit is joining us in the studio. Somit, let's start with Tata Steel. A big news flow happening, a lot of target price upgrades. But is there still a bit of worry on the uncertainty which is there with respect to the employee union, etc., the discussions there?
Well, actually, it's not a surprise news that has come, because a lot of media reports were already speaking about this, and that has come in pretty much on the expected lines. 1.5 billion pound of capital expenditures required, of which 40% will be given by the UK government, that is close to 500 million pound, while the remaining 750 million will be given by Tata Steel. Now, Tata Steel, this means that from Indian operations, whatever funds or whatever surplus they will be generating will be deployed towards the UK operations. Now, the positives coming out of this thing is firstly the fact that it will put a stop to the cash drain that we have been continuously seeing in the UK operations. Because if you see in FY23, the UK operation generated a loss of close to 127 million pound, which increased to around 156 million pound on an annualized basis if we see for FY24 based on the Q1 numbers. It also reduces the carbon footprint, and management expects there could be a cost saving in the tune of around 150 to 170 ton per pound. But the major concern or the major uncertainty that still prevails here is the fact that the company has not provided any clarity on how they're going to reduce the workforce. They have around 8,000 workers. There are media reports that around 3,000 of them could be laid off, and reducing the workforce could be one of the major cost saving that Tata Steel UK operations could see, and that could only lead to profitability, and that is the main concern or the main agenda of analyst community. They want to see the UK operations in profitability, and reducing workforce is the way ahead, I guess.
If the management is expecting a cost saving of 150 to 175, I mean, there would be a little bit of operational efficiency, and there has to be the other factor at play, which is that when you're setting up a new capex, that new capex would be much lighter in terms of efficiency. So it has to be a combination of both. Job cuts is something which nobody wants to come out and share on the public forum, because this is a joint statement with Tata Steel and by the government of UK. So this is something which I think will be work in progress. I don't think job cut is something which any government will come out and say that, okay, when the economy is in recession, I'm going to be doing job cuts. But job cuts, I think, have to happen. Otherwise, they cannot get that kind of cost saving. I see the following happening to the Tata Steel stock. While the overarching impact would be what happens to China, what happens to the global steel prices, historically, Tata Steel has not got its due, despite being efficient, largely because of this overhang of UK. If that overhang of UK reduces, which it is reducing, more than anything else, there's a perception change which eventually I think will happen to Tata Steel. If I compare Tata Steel with, let's say, other global steel companies, or if I compare Tata Steel even with JSW Steel, and I'm keeping SAIL out of equation, it's not got that kind of a commanding premium. But this is an incremental move which I think will kick in. If efficiencies in the cycle are on their side, we are in for a positive surprise rather than a negative drag.
All right, that's the view on Tata Steel. But let's discuss the other buzzing sector, and that is defense. Clearly, it's in the spotlight, Samit, after the Defense Acquisition Council has approved some more proposals that are a push to Atmanirbhar Bharat.
Well, 45,000 crore of proposals that have been approved. Multiple beneficiaries that are there. Firstly, Tata Motors, Bharat Forge, Ashok Leyland. Given the fact that there are light armored vehicles and heavy mobility vehicles also which have been placed in order. Then there is Bharat Dynamics, because there has been missile orders that have been placed. Then there are survey vessels order given by the Indian Navy, because of which there is Midhani, Garden Reach, Cochin Shipyard, which also tend to benefit. But the major beneficiary coming out of this entire orders is Bharat Electronics Limited. They have won orders nearly 3,000 crore rupees, which takes their year-to-date order inflow to close to 14,400 crore. In 6 months, they have achieved nearly 72% of their FY24 guidance. So there's a high possibility that they might beat their guidance, but it's a commendable task that the company has actually able to meet 72% of their guidance in the first 6 months. 14,400 crore of order inflow already.
Look, this is not new, and this is not something which markets would say that it's a surprise. I mean, this entire flywheel effect, if I use the way to describe it, I think it is at play in the defense sector, and defense stocks at a multi-year high. Now, specifically when it comes to the recent, the current order, you would imagine, Sumit, that these are short cycle orders. These are not like long cycle orders. When you're building an aircraft and a ship, those are long cycle orders, 5 to 10 years. In this, there are a lot of short cycle orders as well. Also, I genuinely get a sense that some amount of re-rating, I think, additionally should happen with the private companies, Bharat Forge, Tata Motors, Ashok Leyland. While incrementally the defense business for Bharat Forge is increasing, that's what Amit Kalyani told us. For Ashok Leyland is increasing. So I think the rub-off effect of some of that, I think, will be visible in some of the private companies. You look at Tata Motors from the lens of JLR and EV. You never look at from the lens of defense and what they could do there. Similarly for Bharat Forge, similarly for Ashok Leyland. I think if you ask me, the puck now really could move to some of the private guys, considering that they are also getting large orders, especially in the short cycle capex.
Okay, so the puck might move towards the private capex as well, given the fact a lot of defense orders might come their way, because as it is, the appetite for a lot of these PSU defense companies is quite satiated. The order books are burgeoning as we speak. Let's see when the execution takes place, because the proof, of course, will be in the pudding. But talking about the proof in the pudding, it's also about SBI and the kind of credit growth they are envisaging going forward, because they have been talking about a 12 to 14% growth. But Nikunj tried to, talk with Mr. Khara about what are the chances that they'll be able to beat their own guidance.
As of now, our credit deposit ratio, even at a global level, is also somewhere around 72%. If we look at only the domestic, we are at 65%. We have enough buffer available with us to support the growth requirement of the economy, and we are only ensuring that we pick up the assets which meets our risk appetite, and that is something which our major focus is. So I think we have the required ability to support this kind of a growth, and my normal expectation is that we should be growing somewhere in the range of 12 to 14%.
Was the 12 to 14% you guided for? I'm again being very careful with words here. When your assumption for GDP growth is sub 7. Next year assumption, according to Mr. Khara, is going to be sub 7 plus. So 12 to 14 should become 14 to 16 then. I'm trying to get maybe a headline from you.
No, I'm only trying to say that maybe if at all it is 6.8, it would be around 12. But if it is at 7% plus, it would be at 14. Okay. So the range remains the same.
And SBI has historically beaten the market. So then if I add that as a factor, then 14 should also be beaten.
Let us wait and watch.
We've seen a war of liabilities. Something where you always said, look, the smaller banks are suffering, but for SBI, because of the SLR and the other tools we have, the impact would be minimum. Now that the war in liability, according to you, is settling down, what happens to SBI?
Well, as far as the liabilities are concerned, apart from the war, we also look at it from the point of view that liability is more of a franchise. So we have got large customer base, and we must ensure that their interest is protected. So with that in mind, we have been tweaking the interest rates here and there in some of the buckets, more so in the fixed deposit, and to ensure that we should be in a position to cater to such investor depositors base through offering a inflation adjusted returns also. So I think having said that, we are having a very clear focus in terms of improving our CASA one and improving the CA component of the CASA. Traditionally we used to depend upon the government deposits, but late you would have observed that the government is also moving towards the just-in-time funding of the accounts. And that is one of the reasons why we have started, actually for about 6 months plus now, we had recalibrated our strategy, and we started looking at the trade commerce industry and the transaction solutions in a very big way. And we have already started seeing the positive results of that. And that gives us a hope that maybe the CA component of the CASA will improve.
All right, and we move on to a quick programming note. We at the Times Network bring you Mirror Now Summit Chhattisgarh, which is going to be held on the 20th of September, Wednesday in Raipur. As India's most influential news network, the Times Network channels have been a catalyst for change and action for a better India. With the theme Path to Progress at Mirror Now Summit Chhattisgarh, we aim to showcase the journey that's leading to the change in sustainable agricultural revolution, enhancing the farming methods for economic growth. Chhattisgarh's commitment to enhancing healthcare is also evident, with a focus on high-quality medical services and a healthier future, highlighting the rich cultural heritage. At the summit, we will discuss and deliberate with state leaders and authorities to define a holistic development for the agenda for the entire state. So get ready for all the action right here on the Times Network.
Welcome back. Well, let's put the spotlight in some other stocks which will be in focus today. Of course, SBI Cards is one of them. The management met a few analysts. Let's go across to our mark sheet with the key takeaways from these meetings.
Well, yes, SBI Cards in focus on the back of an analyst meet, and here are some of the important takeaways that have come in from Morgan Stanley. They have highlighted that spending growth is trending well ahead of the festive season. They have highlighted that share of interest-bearing assets and overall receivables also continue to rise, and in fact the share of EMI loans is a bit higher among the tier 2, tier 4 cities, and in fact has become a much popular choice in the super premium segment, which is the non-cost EMI segment. They're expecting the NIMs, that is the net interest margin, to be stable to slightly lower in this second quarter, and in fact as far as the borrowing costs are concerned, they're expecting to see an increase of around 10 to 15 basis points. As far as the operating cost to income ratio is concerned, for FY24 they have given a guidance of anywhere between 58 to 60%, and they have, as far as the asset quality is concerned, they have highlighted that the credit costs are expected to decrease from the second half onwards. So all in all, these were all the important takeaways from the meet for SBI Cards, and that is the reason we should definitely keep an eye out for this counter.
Thanks, Mama. We'll watch out for what happens to SBI Cards today. But it was also Dabur that met quite a few analysts. Let's go across to Winnie, because the commentary continues to be a bit somber, Winnie. Not getting a lot of enthusiasm or optimism from the management's, comments.
Absolutely, but there are certain key highlights that have come in terms of the commentary. What we see is that they're looking to increase their addressable market share. They're going to be focusing on the key growth positives that they have. They want to focus on their three main categories. They have a clear strategy of prioritizing growth. Now, some of the analysts have also highlighted in terms of how the company wants to sustain the personal care segment as well. Their growth, the market share gains that they're seeing in the home and personal care segment, and that is what the company wants to prioritize, as well as focusing on that part as well. Other than that, the company also highlighted in terms of the other things, that is that they want to move from just a power brand to a power platform is what they want to focus on as well. In the healthcare segment also, the company wants to start focusing a bit more in terms of focusing on the doctor advocacy as well, and revamp the strategy over there. Now, in the medium term, they're expecting growth coming in for Dabur for FY25. Some of the analysts have highlighted that Dabur wants to drive a double-digit growth in terms of the revenue growth in FY25, and the EBITDA margins that they're expecting would be somewhere around the 20+% mark for FY25. FY24 maybe somewhere around the 19.5% mark for the EBITDA margins is what we could be expecting. The company also highlighted in terms of focusing on the domestic revenues at 1.5 times the FMCG market and gain further market share. CLSA is maintaining an outperform on this one, target price of 620 rupees per share, while Morgan Stanley, I beg your pardon, is also maintaining overweight rating and target price of 600 rupees per share.
Okay, thanks so much, Vinny, for joining us with respect to what was happening in Dabur's analyst meeting. So not as bad as I was fearing. There are mixed commentaries coming in as well. Let's go across to Sharad now. He's standing in to talk to us about what the commentary was from Zomato as well, because they too met a lot of investors. Sharad.
Well, yes, the commentary was on a cautious front rather than an implosive growth front, and as per the Jeffries, they are expecting that the food delivery business, that is expected to be the cash cow of the business and expected to grow roughly 20 to 25%. While if you look at the quick service business, the quick commerce business, that is expected to grow in at a 60% CAGR levels. Apart from the numbers, the food margins, that is expected to grow almost 5% on a medium-term basis. And an important statement coming in is, especially for the quick commerce business, that is expected to break even over the next 4 quarters. And of course, do remember in the first quarter of FY24 itself, the company on a consolidated basis did turn profitable operationally as well. And the current take rate is roughly 27%, considering a mix of restaurant fees, ads, as well as revenues coming across the fees, and this is expected to come in at roughly 30%. Now, Blinkit in certain places is actually larger than Zomato, and especially on the order size value as well. That commentary has been bullish coming from the management, and also the company itself is watching the ONDC grow, how it's actually panning out, especially for the food delivery segment. But there is currently no perceptible risk coming for the gig worker regulations as well, and the hyper pure customers acquisition cost has come down to nearly zero. Now that is important because the cost of customer acquisition is something which is a very big pain point for the startups, especially in the growth segment. Now there are no plans for international, and we did know that a lot of their international arms have been winding up their operations, and the company itself will be looking out for new opportunities, but the foray in the new line of business will only come upon the management's confidence. So there is a cautious tone, but growth underlyings are always there.
All right, thanks very much for giving us those details, both Vinny and Sharad. All right, let's get a move on and connect with Sandip Sabharwal, who's joining in on the show. Hi there, Sandip. Good to have you. Let's begin by talking about that tremendous rally that we witnessed within the entire PSU banking space. Now, you can attribute it to the fact that there has been a change in the overall fundamentals with strong credit growth, recoveries, asset quality as well has improved significantly. Do you believe that this run-up is here to stay?
So there are two parts to the PSU banks rally. One is that after the news of the inclusion of Indian bonds into the bond indices, we saw a rally in government bonds. I think that was a positive fillip. And secondly, it's a part of the overall move in PSU. If you see how many of the PSUs have moved, so many smaller PSUs have actually almost doubled or more than that during this year. So I think it's more a PSU play than a specific PSU bank play. Longer term, I don't recommend that people should keep on buying PSU banks at higher and higher valuations, because I think from this quarter, next quarter onwards, we'll start seeing some uptick in NPAs and a squeeze in margins, which was not there for the last few quarters. So I think some allocation is fine, but I think excessive allocation to PSU banks doesn't make any sense.
Make it tempered allocation if you must to the PSU banking space, but the rally is across PSUs and not just banks. In fact, talking about PSU, Sandip, defense is one space which we were discussing earlier in the morning as well, that it might be up for another leg of re-rating given the kind of project approvals that have come from DAC as well. Any stock that you like from the defense space that you still think could be bought?
So I think the oldest one, which is the most steady one, Bharat Electronics, I think that's the only one I would think that still offers decent value. Rest of them, at least on the PSU defense side, the move has been too rapid. And at these valuations, it's tough to buy them. So I think there's no reason for, so there are two things to it. There's no reason for people who are holding these stocks to sell, because there's no logic behind it, because even if there is some correction, the old investors can ride it out for the long term. But for people who want to take fresh exposure, I think the runoff has been too swift. So every new order cannot lead to a new re-rating, because that is something which is expected, that order flows will continue, and that's already built into most of these prices.
Okay. Another stock which I think is worth revisiting is Jubilant FoodWorks. Sandip, Zomato has gone from 50 rupees to 100 rupees, and Jubilant FoodWorks, which is in the same business, makes profit. It's a play on demographics, strong cash flows, a decent balance sheet, has done nothing. So if QSRs are doing well and if World Cup is around the corner, do you think this could be a sitting duck stock idea?
So I think, Nikunj, there are two parts to it. Zomato benefits from the overall growth, so it's agnostic. So it doesn't matter for Zomato which food category, which restaurant, what is doing well, as long as the overall pie is going. So that's very different from what Jubilant is facing in terms of intense competition from Pizza Hut, other pizza chains, as well as their internal issues related to low ROCE expansions. So, one, you are right that sentimentally, as the World Cup is around the corner and there is a general expectation that food ordering will improve, that could be sentimentally positive. But fundamentally, the stock is still very expensive given the kind of earning downgrades we've seen for Jubilant, as well as how it's performed relative to many of the other companies like Westlife, Devyani, and a few of the other listed QSR companies.
Okay. I'm going to again go back to PSU banks with Nooresh. Nooresh, the leader is SBI, and in this market comeback in PSUs, SBI is underperforming. UCO Bank, Bank of Maharashtra, the smaller ones are the ones where the action has started. It's like saying the tail has started wagging the dog.
So what has happened in the PSU bank spaces, in the first cycle where we started re-rating was in 2021, which is where SBI went up from 300 all the way to 600 by 2022 end. And in that period, we did not see as much of a outperformance in a lot of these smaller names. And now we've started seeing this outperformance coming up. So if we look at, open up a chart of Bank of India, the stock topped out at 100 in Feb of 2021, went down to 45. Again, started a rally in October 22, went back to 100 levels, then came back to 70. And now now it is back to 105. So essentially, over the last 2 years, the returns are not that great. It's just that the volatility is much higher in a lot of these smaller PSU banks. They saw a correction of almost 30% from the top in 2022 and 30-40% from the top of 2021. So we are coming back and crossing those levels. So that's generally an indication of a new cycle coming in of re-rating. And mind you, most of these names have corrected a lot over the last 10 years. So many of these names, say a Bank of India is available at the same prices where it was in 2005 and even 2004. So a lot of these smaller PSU banks have been major underperformers for the last almost 15 years. So what we are seeing in the near term is a short-term outperformance, and the trend is pretty positive in some of the names. But one has to be careful because the volatility is high, and once they top out, they tend to correct 20-30% as such. So the names which I like the most is something like a PNB, which has given a breakout and it has corrected the most also over the last 15 years. The stock is finally above pre-COVID prices of 65. On dips to 70, that remains up high. Then Bank of Baroda on dips. Can Bank has already moved up in the near term. The rest of the names, UCO, Central Bank, etc., one has to be careful. They've made a short-term move. So overall, be careful here. The risk reward is not great, but yes, the short-term trend could continue.
Right, stay on with us. And which are the pockets that you should look to bet on after this bull charge? Well, we caught up with some top market experts, the likes of Dinshaw Irani as well as Vineet Samre and Anand Shah. Listen in.
Our major themes going forward, and that's where we're very bullish on, is financials and discretionary consumption, and also affordable luxury kind of consumption that we're looking at. Discretionary is what we're looking at, and there again in say aspirational luxury. So obviously hospitality comes in a big way. Pure textiles move in here. There are shoe companies as such which come in, and obviously these are few sectors that are playing out for us.
Without labeling them as defensive or growth, I would say that bank today makes a lot of more sense, because whatever growth we are talking about in the economy, definitely it has to happen through the banking sector. I keep talking about IT as one of the sectors which I generally have a positive bias towards because of a simple fact that this is a very strong cash generating sector. And more importantly, this is a sector which also distributes a large part of the profit back to the shareholders. And hence, from let's say dividend yield or cash flow yield perspective, this is one of the better sectors to look at.
While the Indian consumer story is not lost to anybody, Indian consumer has been doing well for last couple of decades. We have a large middle class population where the dependency ratio is falling, per capita income is rising. So obviously Indian consumer story is not going anywhere.
Okay, so that's the take coming in. The Indian consumer story is not going anywhere. Just wanted to discuss a couple of other stocks as well. Kunal, what's your view on NCC? The stock will be in focus today on account of that arbitration claim that they have got. Of course, it's lower than what they were expecting, but at least they're getting almost 200 crore rupees. And Bajaj Auto, that was that stellar outperformer on Friday with that 6-7% move. Do you expect a reversal today, or the momentum will continue?
I think Bajaj Auto could be a case of a breakout. My sense is that the stock has done pretty well for itself. And when you look at this consistently from start of 2023, the stock, which is almost at 3,500, showed patterns of higher highs and higher lows consistently, which means that it's an indicative of a very strong trend coming up for Bajaj Auto. And within the process of a trend, when the stock consolidates for a extended period of time, we expect the stock to get into a sudden breakout, to just convert the mean reversion of the time-wise consolidation and going to a breakout. We saw that happening for Bajaj Auto on previous week Friday, so I'm expecting the stock to get into a follow-through up move. More importantly, this pattern of higher highs and higher lows should continue for the stock. NCC could be a classic case because the stock has already corrected. I think if I'm not wrong, 175 was the previous high for NCC very recently, and the stock is back towards that 145 mark. So it's already baked in a correction of 15-17% recently for NCC. I would probably expect that maybe it's coming very close to a bottom out formation, and I would actually go for a contra buy on NCC in case if the stock dips marginally today.
All right, let's get a move on then and put the spotlight on the stock on the editor's radar. Today, it's AU Small Finance Bank. And Nikunj, if we map out the charts on a year-to-date basis, it has been a bit of an underperformer, but lots of triggers down the line.
See, I think independently, the franchise has done well for itself. Loan growth of 25% plus, really no NPA problem whatsoever. And also in terms of risk management, what they've done, I guess they've got a very neat franchise in terms of the technology they've built up. I mean, CASA was a challenge for them, but I think in this war of liability, AU has done rather well for themselves. But I've got a very interesting Nomura note in my hand, where there's again a media report that AU is looking at acquiring a small finance bank in the south. Yeah. And if that goes through, what could be the impact of that? Now, if you assume that AU is going to be going ahead with one acquisition, the first big acquisitions ever since they've gone public, in the near term, it clearly means that AU is looking at diversifying outside the cohort, which is the western and the northern region, to the south region. I think they need that growth because they have to expand up until now. Otherwise, they would be known as a very regional player. So in the near term, if the acquisition goes through, of course, it will have impact on the return ratios and the ROAs. But I think in the medium term, That is where AU needs to build. They have to come out of the strong cluster, so to speak, and focus on the other areas. I guess what I like about AU, Avan, is the fact that they build a franchise which is high growth, but very low in terms of NPA problems. They are not a universal bank, but I guess the book is so solid that the fee-based income is also coming decent. Now it's expensive. The problem with this franchise is expensive, and if they go and acquire another small finance bank in the near term, it could lead to dilution about 4 to 5%. So in the near term, it could be pressure, but I guess 18 months, 24 months from now, the benefits of this kind of an acquisition would be seen through, because if AU does not grow, they would pretty much be restricting themselves to being a regional player with very little presence in South.
Okay, and this could be a key trigger as well, expanding their geographical presence. So that's AU Small Finance on the radar, Anisha.
Okay, so that's about the AU Small Finance Bank and the editor's take on that. But let's also take the view coming in from Sandip on that. Sandip, AU Small Finance Bank, as Savan was also saying, it's been underperforming, and Nikunj talking about how it could be a bit of a re-rating candidate as well, given the acquisition might happen.
Oh, I'm not a great fan of M&As leading to re-rating, especially when markets are so high. So I think that's something we need to watch out for. I think at one point of time after interest rate hike cycle and after interest rates have remained high for some time, we need to be more cautious about financials which are trying to grow very aggressively and much above the market growth rate, rather than trying to become bullish about them, because aggressive growth at high interest rates, as has been shown in all previous cycles, has led to balance sheet stress. So I would be cautious on many of these smaller banks which are trying, or NBFC which are trying to grow very aggressively at these points of time, and where the CASA franchise is also not as great as many of the larger banks.
Okay. Let's look at metal stocks, and that's where I guess we've debated that China one side slowing down, US on the other hand picking up. Metal stocks in general, I guess they've been both hot and cold, neither here, neither there. Sandip, this is one space where traders have historically looked at the trend. What is the trend in metals according to you?
I think next 5-year trend, if you ask me, is metals are going to go nowhere, because China still is 50 to 60% consumption of most large industrial metals, and it's going to a deep stress slowdown, especially on the fixed capital side, where many of these commodities will suffer. The counterpoint could be that decarbonization-led capacity shutdowns could balance out some of these demand concerns. How that plays out is something we'll need to see. But one, there's going to be no super cycle to play. And secondly, I think there'll be better sectors to play rather than metals.
Okay.
But any thoughts on the Tata Steel deal specifically, if you have gone through it?
That's a positive, because it was in pending for a long time, and finally it will become, as per the management statements, it will make those entire operations viable from being completely unviable. So I think incrementally that's a positive aspect. Steel prices incrementally have also moved up. Stocks are subdued. So I think these are underowned stocks now. So small positives can create moves, but these moves, I think, will not be very substantial. So I think 10-20% move in metals is the best we can hope for.
All right, stay on with us. Let's hear out some top fundamental stock ideas. We spoke with Sanjeev Bhasin, and let's find out what he's recommending.
A long time I have not seen L&T hit new highs. So has NTPC. So has Coal India, which has surprised, 220, 270 in almost a couple of months. And it's telling you industrials, power, hydrocarbon, engineering, electrical, this space is rocking, and there is no two ways. Cummins, Thermax, ABB, Siemens, you name it. L&T takes the cake. Now their order book is so large, and the execution is, always questionable for the PSUs, but not for a private company like L&T. And now they're talking of double-digit margins. So I think power, infrastructure, and the likes of L&T, Coal India, NTPC, And I'll give you a couple of dark horses on the mid caps, which I think can be equivalent to the return, which if you are looking for that. But L&T overweight, NTPC and ONG, Coal India are also three overweight stocks for us. Coal India which were discarded because of thermal and other issues, is now revving up. And I think that this whole Ukraine-Russian crisis has actually turned out to be a blessing for them. You see the dispatch numbers. It's the third largest producer of coal in the world. And I think it is just getting its recognition.
If we look at the entire cap goods as a place, so I think my preference would be more on the terms of the private players, rather than BHEL. So maybe at this price, I would avoid BHEL. Maybe at correction, I would look at it for a longer term play. But if I have to look at something like Siemens or something like ABB, though the valuations are expensive, but I feel that there will be a safety and the risk versus reward would be quite favorable from here. So I think again here the returns could be also a very moderate kind of a return. The stock has done well, so I think these are only 12-15% compounder from here. So that is what it looks like. So my sense is I think again Siemens and ABB remains the top bets in that entire sector.
Sandip, the other theme is power. Merchant power, power transmission, power utility, power finances like PFC, REC. Unlike defense and railways, power is more like a short to medium term theme, where there is power shortage in the short term. Supply is less and demand is more. What is the best way to capitalize on this entire, power cycle per se?
So I think I like to buy the equipment companies, the transmission companies, the companies which build the plants, etc., rather than the power generators, because I think in India we've seen in various cycles that the power generators tend to get their margins squeezed as politics takes over. Power distribution companies typically have been loss making, so their dues keep on growing. Now, something is changing out there with the entire smart metering, prepaid metering aspects. So I think that would reduce the risk of the overall sector. But buying power generators, which is typically a very low ROC business, you see the return on capital of most of the power generating companies in single digits. And many of these stocks have just zoomed up. Like even the smaller companies out here have zoomed up twice, etc. Many of the PSU companies which actually are some of them making losses, have doubled this year. So I think there is need for caution out there, but the investment cycle is strong. So whoever the equipment suppliers are the lowest risk players out here, and that's what people should play.
All right. What's the take then, Sandip, when it comes to the entire chemical space, owing to the fact that the crop prices have been under a bit of pressure and experts are saying that the rising input costs could impact farm profitability. What's your sense?
So you're asking about agrochemicals, right?
Yeah.
Yeah, so the agrochemical cycle is going through a stress, obviously, in both domestically and globally. And the main issue is high inventories in the system. So the high inventories in the system will lead to lower primary sales from the producers into the market. So I think that, and it should take at least 2 quarters for those inventory issues to get sorted out, even if the market revives. So I don't think there's any great story. Many of these stocks have got sold off a lot, and to that extent, there's a buying coming in because of that, because these stocks have got sold off a lot. But in the near term, I don't think there's any revival happening.
Okay, no revival as far as the agrochem is concerned. But Nooresh, a chart check going for a lot of these sugar names which had seen quite a bit of rally last week, and also Vodafone Idea. We understand the reason now why that stock was surging, because they managed to prepay almost 1,700 crores.
So in terms of sugars, I'll start off with the main one, which is Balrampur Chini. The stock finally broke out above the 420, 430 mark. The volatility remains because the stock keeps going into derivative band. But technically, the breakout is done about 420, 430 last 1.5 year. Every time it would come to 420, flipped back to 360, 380 levels. Finally, the breakout is done here. Should ideally go towards 520 over a period of time. A lot of other names have already broken out and made larger moves, but there would still be an opportunity in the Dhampur sugar, which has broken out about 290, 300 levels on dips. Dhampur remains the next bet. The other names like Dalmia, Awadh, Magad, etc. have already moved up quite a bit. So that looks, as a sector, one needs to wait for the smaller names for dips, but Balrampur and Dhampur look interesting. In terms of Vodafone Idea, what is interesting is the fact that the volumes in this move has been very good. So from the move of 8, 8.5 to almost 11.5, 12, the volumes have been almost 2x, 3x the general volumes. If we go back almost a year, 10 was the high in 2022, roughly in the end of it. So we've crossed about those 10 levels, and the next major price point is now closer to that 14 mark, which is where it saw a last major gap down from. So I would expect 13.5, 14 to be a resistance for the near term and a target price also. And one could keep a trailing stop loss at 11 here.
Sandeep, when I say, I'm saying this with a lot of sincerity, and that is a reality, which is that now and then, earlier it was now and then, now it is regular. There is always 1 or 2 WhatsApp rumors every week about the future of Vodafone. What should one do? I mean, just avoid Vodafone, or there is something which could happen in Vodafone, and what people are talking about it being a multi-bagger, it may just happen.
I think I'll go with the first option. Avoid it. Don't even track its stock price. Don't even look at it. It's a bankrupt company.
Let's understand the fundamentals here, and let's break it down for our viewers. I just want to make this bite, even out on our digital platforms, that why should one avoid looking at Vodafone completely and totally, even for trading and investing? Sandeep.
It's a bankrupt company. It has no value left for equity shareholders. The kind of debt it has and the cash flows it is generating and can potentially generate will remain negative for years to come. There is no revival inside. They are losing market share, and this is a very high operating leverage business. Telecom people need to understand, because once you have set the capacities, every incremental subscriber you get, you make money on that. But every incremental subscriber you're losing, then your losses get magnified. So I think the fundamentals of it, entire aspects of Vodafone Idea are so negative that it cannot generate any return for its shareholders. Now, you want to play momentum, you want to play it just because everything else has moved up and it's available at 10 rupees, you can do it. But then once you start riding the tiger, then the tiger decides when you get off. You don't decide it.
Which tiger have you been riding, my friend, that you're giving this kind of an analogy?
I ride a few tigers, but then I try to jump off early.
I think what everybody is riding right now is that bull run that we are witnessing across the board, record high levels and all of that. So not tiger perhaps, but bulls definitely.
Yep. We actually had a show called Riding the Bull, and then the bear market came here to take the show off air. But I think it's time to...
But then you could also ride it there. We could have just changed the name of the animal perhaps.
I was not sure whether it's a real bull bear market or not. So in India, you don't have a bear market. See, in India, you have to realize that India, I always say this, that never go short on India. The decade belongs to us, right? You can talk about incremental things going here and there. And the way to make real, and Sandeep and we've really spoken about it. I give credit to Sandeep, I've learned it from him, that you buy the bad news in the world when it comes to India. So the bad news in the world will have an impact on Indian stocks, and that's the time you buy India. So whether it is 2008 or 2020, 2021. So when there is bad macro sell-off in the world, you buy India. I think Patricia must have got the data wrong, that when do bull markets have peaked? And Sandeep, I'll just come to you. Let me just read off the data here. When a bull market's peaked...
You want to take a minute?
We'll take a bit of a break, but it's interesting really to get a Nikunj's take on this, because he's talking about, the previous times when we have seen these events that have really, had very big ramifications. And Nikunj, if we were to start off with 2008, 2009, the global financial crisis.
India in a bear market, my throat choked. It was natural reaction. It was a natural reaction.
Didn't even say those words.
So Sandip, I'm just moving away from defense and railways, but here's the data that the bear markets, whenever they've happened, it's largely because of global macro.
Yeah. So all big corrections happen due to global macros. So we cannot ignore global macros. So that's the most important point out of this data. So when people say that everything in India is so good, I agree. Everything in India is good. But then when there are periods of time when global macros or global aspects turn adverse, and at that time we need to turn cautious. So I think that's the biggest takeaway I would say from this data.
Okay, fair enough. Meantime, media stocks, and they've really been buzzing. And Kunal, I just wanted to get in your take on some of these names. For instance, like a DB Corp, the last 6 months return, of course, it's been like 150%. Z Entertainment, yes, there have been lots of contentious issues with respect to the merger. But nonetheless, in the last 6 months, the stock has gained about 30% or so. And then we've seen a slew of hits coming in from the multiplex companies. So that has kept that, space very active and alive. And even something like Sun TV has gained close to 40% in the last 6 months or so. What's looking good here?
Yeah, I think DB Corp I don't track very closely, but yes, even that stock has done pretty well. I think from 95, 97, just about 2 or 3 years back, the stock is at 200 plus level. So been an exceptional return generator, and I think it's been more of a straight line rise for DB Corp. But the two charts within the media space which I do track very closely, and the ones which have given breakout, one of course is Sun TV, because I think that's a stock which had been a huge underperformer, and we're talking of 3-4 years of underperformance for Sun TV, where the stock corrected, consolidated for an extended period of more than 1.5 to 2 years. And then all of a sudden in the last 2 or 3 months, we've seen a major breakout coming back for Sun TV. The stock coming close to that 600 mark, which is a major breakout point for Sun TV. And I think the last time in terms of the indicators, the etc., when the stock was positioned, the stock had given returns of more than 50% in the span of the next 6 months to 1 year post such kind of a breakout. So I would probably expect something similar going on for Sun TV this time around, and hopefully in the next 1 or 2 years the stock can deliver such kind of a strong returns. Z Entertainment, the stock has been into a lot of news flow, so very difficult to give a strong technical view, but yes, the momentum has played out quite well for Z Entertainment so far, and we can expect that this time the momentum can take the stock back towards at least 285 to 300 zone.
So momentum has been strong in some of these media names, but Sandip, it's FMCG which has been massively underperforming. I mean, if you look at the last week data as well, Nifty FMCG was the biggest loser, and a lot of these names, right from Asian Paints, call it the crude impact or the monsoon and demand impact. They haven't been doing much. Is it the time to buy these stocks, or do you think there'll be more lucrative levels coming which will give you the opportunity to add these names?
So consumption has been suffering as a result of high inflation for the last couple of years, and that's got reflected in these stock prices as they were relatively overowned, and then the other sectors started to do well. Now, some stocks in this sector are providing opportunities. So wherever these stocks correct 20% from the top, we take a look. I think Asian Paints has its own issues going because of entry of Grasim into the paints sector, growing competitive intensity, and so to that extent it's a different story, but possibly something like Dabur, Godrej Consumer, or Britannia, I think these are the stocks on the lookout we can buy at lower levels.
Okay, now this entire urban consumption theme is the standout theme for this year, whether it is Ethos, Sula, Bikaji, Varun Beverages, well, not urban consumption, but yeah, the stock's done very well for itself. So Ethos this year is up 69%. Sula, right from the word go, the IPO was not that great and it has just managed to hit out of the park. And then you got Bikaji also, which has done rather well for itself. Sandip, anything in the new IPO which looks attractive in terms of a business, becomes a buy at a lower level, is expensive, but when the market declines, it's a great business to buy?
I would say that Dr. Bector's is something which I looked at where we took small exposure, we couldn't increase because the stock just zoomed up. So like you said in your comments, stocks is expensive and we should look at it on a reasonable correction. So I think that's one company whose business model I like.
talking about the IPOs, of course, you talked about the ones which listed in the last 2 to 3 years, but a lot of IPO action lined up this week as well. Of course, the IPO that opened for subscription issue names like Sai Silks, Manoj Vaibhav Gems and Jewels, and then IPO which are closing in as well. There's Sami Hotels, Zaggle Prepaid, even Yatra Online. Sandeep, any name that you have tracked and liked?
Put IPOs on the sideline. I think there's the frenzy on the IPO side is so crazy. I don't know. Like one that doesn't make any sense. I don't know what allocations we'll get. Nothing. And secondly, I think the frenzy is so great that I think this kind of frenzy doesn't lead to. So I think the end is not good. I would say so. People should be very cautious putting in big money into IPOs.
Certainly a very extensive list, and it's been a buzz at the primary markets. But Sandip, does that thought extend even to the listed fintech players?
Yeah, so I think on the listed fintech players also we've seen a substantial rally. Now, a large part of that has been driven by management commentary on profitability about the future and changing business models. Some of it is real, some of it is something which will be tough to achieve. So I am not a buyer in any of them at this stage.
Okay, Sandeep, on that note, we let you go. Appreciate you joining us. So those were the top fundamental ideas coming in from Sandeep as well. But let's get the technical ideas and the top mid-cap ideas coming in from our chartist. Nooresh?
So that would be a buy on Biocon with a stop loss at 268 and a target price of 320. The stock over the last 3 months has been making a tight consolidation between 250 on the lower end and 275, 280 on the upper end. Strong base made around those 200 to 250 marks, spent quite a few months there. The stock went through a correction of almost 50% from the top. 450, 480 was the top in 2020, corrected all the way down to 200, and now has started making a comeback, higher tops and higher bottoms. So looks like a short-term breakout in play here. Would expect a move towards 320, but could surprise on the upside over the medium term.
All right, there you have it. That's Biocon from Nooresh. What is it that Kunal is picking out, Kunal?
That'll be a buy on NMDC, the stock which had done quite okay in the last couple of days, heading towards a breakout of 150. The stock, looks very ripe for a very strong up move on the short term as well as on the medium term chart. So would suggest a buy 160 approximately as a target and stop us at 143.
Okay, so that's the top bet coming in. The pre-open rates are trickling in, and there seems to be a bit of a red tick, not by a whole lot. 20,150 is what we are looking at when it comes to Nifty, and the Sensex down about 70 points. Let's quickly track some of the stocks as well. Let's start with Tata Steel itself in terms of what reaction are they getting to that restructuring. The likelihood of it is that it will start in the green, and that's the pre-open rate coming for you, 2% higher. In fact, let's discuss that further with Aditya Velekar, the senior research analyst at Axis Securities, joining us on the show. Aditya, hi, good morning. Thanks so much for making time. Your first take as to the deal that the UK business has managed to struck.
Yeah, good morning. So the first reaction is positive. The overhang on the stock, which was there because of this UK restructuring, that is to a large extent it is now removed. Only thing is the employee negotiations with the unions, that is one pending area which will decide the full restructuring amount in future. So if that comes out well, then this is overall a positive news. But the first step itself is positive, the 500 million pounds grant from UK government. So the company has also said that they will be saving some cost with the electric arc furnace installation as compared to their previous blast furnace. So overall, good escape for Tata Steel from that loss-making UK unit.
The management is talking about a 60 to about $75 per ton kind of in saving. Do you think that will also entail more than efficiency, some job cuts also? Aditya?
Yeah, so that saving of 150 to 125 pounds per ton, that includes... Hello, can you hear me? Hello?
I think we lost his feed there. My limited point is that markets knew this was coming. Incrementally, this is something which has been an overhang. Tata Steel has not commanded a hefty premium, even though at the peak of the cycle. Why? Because even though India business had a glorified and a glorious 2021, and they ended up making profits which were higher than even TCS. Yeah, I think 2020, FY22, FY23, Tata Steel had profits which were higher than that of TCS.
Really?
Yes. Yes.
Wow.
Hard to imagine.
Yeah, that must be some windfall gain that must have happened or something, because it's just hard to imagine. Interesting.
But that's how the cycle was. That's what I mean. I'm absolutely clear in my head that that was the right number, but I don't know the quantum. Just Google it for last year.
Yeah, and I'm just trying to do that because I'm just surprised as to what led to that. It could be the case that it happened, but what was the reason for
That's
that?
what. See, what had happened
intriguing
after COVID was that interest rates came down. When interest rates they come down, as the new capex cycle which started, commodity stocks were in a multi-year bear run. The demand really started coming up. So there was a huge comeback trade in commodities. So global commodity prices which were at a multi-year low, because the way how liquidity came down, the demand structure in late 2020 and 2021 changed completely. So I think for FY22, Tata Steel had this very amazing record year, so to speak. But what is the khabar? For all the khabar, let's go to Sharath.
Well, yes, in focus we are having macro tech developers, and the buzz in the street is that the company is developing its large land bank, and now of course the large land bank which is located in the Mumbai metropolitan region. Now why this is important is because the company will be actually focusing on the digital infra space, and there are certain important business verticals where the company would be foraying into. Now these includes logistics, light industrial products, as well as the digital infra part, which includes the names of in-city fulfillment centers also. Now the management also recently stated in a meet that the digital infra business would be coming up on their 4,300 acre land in the Mumbai region, and they're targeting an ROE of around 20%. That's the delivery numbers which the management had stated. Also, the completion of large infra projects which are actually nearby the company's land bank, that would be something which the street would be watching out for. So this is the khabar coming from macro tech developers.
Macro tech developers, we will watch out for that stock and how sales are really panning out. Thanks, Sharath, for that. But let's also put the spotlight on AU Small Finance Bank and get the editor's take.
See, I think independently the franchise has done well for itself. Loan growth of 25% plus, really no NPA problem whatsoever. And also in terms of the risk management, what they've done, I guess they've got a very neat franchise in terms of the technology they've built up. I mean, CASA was a challenge for them, but I think in this war of liability, AU has done rather well for themselves. But I've got a very interesting Nomura note in my hand, where there's again a media report that AU is looking at acquiring a small finance bank in the south. Yeah. And if that goes through, what could be the impact of that? Now, if you assume that AU is going to be going ahead with one acquisition, the first big acquisitions ever since they've gone public, in the near term, it clearly means that AU is looking at diversifying outside the cohort, which is the western and the northern region, to the south region. I think they need that growth because they have to expand up until now. Otherwise, they would be known as a very regional player. So in the near term, if the acquisition goes through, of course, it will have impact on the return ratios and the ROAs. But I think in the medium term, that is where AU needs to build. They have to come out of the strong cluster, so to speak, and focus on the other areas. I guess what I like about AU, Avan, is the fact that they build a franchise which is high growth, but very low in terms of NPA problems. They are not a universal bank, but I guess the book is so solid that the fee-based income is also coming decent. Now it's expensive. The problem with this franchise is expensive, and if they go and acquire another small finance bank in the near term, it could lead to dilution about 5%. So in the near term, it could be pressure, but I guess 18 months, 24 months from now, the benefits of this kind of an acquisition would be seen through, because if AU does not grow, they would pretty much be restricting themselves to being a regional player with very little presence in South.
That's AU Small Finance, but as we're inching towards the market open, let's also find out what the index calls are from our chartists. Last week was a pretty memorable one, given the fact that we hit some historic levels, closed at a record close. The Nifty Bank as well powered through. No trade, but it's tilting towards a hold. That seems to be the consensus call on the Nifty index this morning, is what the market moodometer is declaring. Let's also find out what the view is on the Nifty Bank Index, and there you have it, 3 unanimous hold recommendations. That's the view on the Nifty Bank.
Scanning through PSU banks, and in my book, I think that's the real pot of gold, so to speak, for this week. Now, PSU bank index, let's look at the PSU bank index, and I'll request my producer to fire the PSU bank index. I mean, a 5-year or a 10-year. It has a 10-year chart, right, Kunal?
Yeah,
it has a 10-year chart. Let's spend a minute on that. The 5-year chart of PSU bank and the 10-year chart of PSU bank. I think we made a new high there, right? So it's like a multi-year breakout. That means that when there is a multi-year breakout, it will not just be like a flash in the pan.
Correct.
It will be something which will be sustaining.
Yes.
That's what applied to Nifty.
Correct.
That you touch 20,000. See, I'm learning from you, Kunal. So the same theory can be applied for PSU banks.
Yes. The longer the time the index or an asset class takes, the much bigger could be the potential breakout. We've seen that happening for various asset classes across the board, not just the individual stocks, but even for indices and key asset classes as well. Now, the other way to look at Nikunj, is that whether the indicators even on the short to medium term charts, are they overbought or not? And the data is quite interesting because we are nowhere close to the overbought territories for the PSU banking stocks, and I'm talking of the 3 major previous tops in the last decade. I think 2014, 2021 and 2022. In all of those previous attempts, the index is nowhere close to the overbought territory, whether it's in terms of RSI, whether it's in terms of the divergence from the key moving averages, the 50 DMA and the 200 moving average. So we are nowhere close to that. And then looking at the potential of a breakout, what we've seen is SBI is still an underperformer as compared to the other PSU banking stocks. So the mix of the PSU banking stocks is not extremely overbought even within the space. So I think looking at that, I don't sense that this could be a minor breakout, but this could be a huge breakout for many of the PSU banking stocks.
So you can still jump in, right? I mean, for somebody watching the screen, it's not late.
Absolutely. You can still jump in.
So what stage of this breakout are we in? Is this the early stage?
So we calculate trends in terms of 5 waves. The first wave going up, like what we saw in 2022 second half, where there was a 30-40% rally for the small cap names. Then came a phase of correction. This is the third wave which is starting off for the PSU banking stock. So we may be at a start. We've already started the third stage for these PSU banking stocks, but there could be a significant way ahead for these names. So even at current levels, I think traders should try and position themselves into these names.
Actually, Nikunj, I had a thought. You're just being devil's advocate here. Don't you think it's time to also exercise a lot of caution, because crude is no longer at those $75 mark. It's 95. Dollar index is 105. The treasury yields have been going up. Rains haven't been as good as expected, because right now we're at 10% deficit as well. Don't you think it's time that the street is just not willing to take into account any bad news?
So Nisha, are we in for a scary sell-off because of crude or because of bad rains? The answer to that is no. A scary sell-off in the global market would be a function of something unexpected or something unprecedented. For example, COVID. For example, the crisis in the US regional banks. So if you're talking about sharp reversal, the answer to that is no. But yes, you're absolutely right that as markets, they keep on going higher, the margin of safety obviously will get diluted. So what you don't want to do in this kind of a market, you don't want to make costly mistakes. Best investors have always told us that worst of the mistakes are made in best of the time. So you don't want to make a costly mistake. Costly mistake is like you disproportionately allocate money to a small cap or a mid cap stock. In large cap stocks, I think that margin of safety in terms of valuation and trajectory, I think is not bad. And within that, IT is a bit of a contra, but with deep margin of safety, banks is where there is a lot of growth. It is a consensus buy, but I think this sector has done nothing, so I see potential there. Where you can argue back and say that, the valuation, the margin of safety, it's missing. There are a lot of these concentrated pockets. So they have 2 options, Anisha. You can look at macros and assume a correction is around the corner and sit on cash. Great strategy. Second, you can look at defense, railways, a lot of these, other overbought stocks and say, okay, are those 4-5 sectors representing the true nature of the market? Maybe not. Third, you say, look, the market and economy is in a good, fine fettle. Where will I go and buy? Well, there are a lot of stocks, whether it's banks or whether it is IT, some consumption names, where the trends, I think, are going to be strong and supportive. So first rates, Monday morning, we start a brand new day, a brand new week, and the first rates will just start kicking in. So I'll start measuring the rates when they start coming up on your screen. It's a truncated week, folks, but it's a good start. The breadth, I think, has been the most enviable part if you've been missing out the rally, but that's also been the most joyful aspect if you've really participated. Bank Nifty not off to a great start. Small cap indices, they're doing the best, which is that they continue to outperform. You want to shift gears and talk about Tata Steel, stock in news. I don't expect a big move there, but in terms of a rub of red, well, there is a rub of green there, I beg your pardon. Then look at banks, PSU banks, Union Bank. Let's look at SBI, BOB, UCO Bank. All that entire banking cahoot is off to a great start. Throw in some of the defense names now. You cannot miss them for long. Throw in all the railway names one by one. You cannot miss them for long. And last but not the least, you've got names like Zomato, Paytm, defense, just about everything in the space. I think it's looking very, very charged. Anisha?
Well, yes, so apart from defense and the PSU banking names that you talked about, telecom is also doing cartwheels. So Vodafone Idea continues the up move for whatever it's worth. 12 bucks a piece, but nonetheless that stock is high by 6%. Indus Towers seeing a surge of almost 3%. And then you have the power and power ancillary, especially the green energy ones. So Adani Energy, for instance, Suzlon, Triveni Turbine from the broader markets. These are some of the names which are perking up, but not a big trend that we are witnessing right now, apart from the fact that it's of course the mid cap and the small cap space which is outperforming. But other than that, not a big sectoral move coming in. In fact, all sectors have started in the red, with the biggest laggard being IT. Infosys is already down 1.25%. Persistent, HCL Tech, Tech Mahindra, they're all seeing quite a bit of profit booking. So these are the stocks in focus. But let's take the first trades from our chartist.
Absolutely, we'll do just that. And Nooresh, what is it that's catching your eye on the screen with a healthy market breadth, a bit of a follow through but a quiet move this morning?
So looking at UPL Limited, the stock seems to be bottoming out at 625, 630, an entry point for the short term.